2008 crisis, Aladdin's big break. In 2008, as banks collapsed and markets panicked, the US government faced a huge problem. Nobody knew what the toxic assets were actually worth. Mortgage-backed securities had become so complex that even the banks holding them couldn't properly value them. That's when everyone turned to one system, Aladdin. The Treasury Department needed answers fast. These toxic assets were bringing down entire financial institutions. Traditional valuation methods didn't work because the underlying mortgages were too messy. Enter BlackRock and its secret weapon. While Wall Street firms were scrambling, Aladdin already had models for exactly this scenario. Aladdin could do what others couldn't. The system treated every asset as a collection of data points. It analyzed the actual loans behind each security, their default probabilities, and regional economic factors. This let Aladdin cut through the noise and calculate real values when no one else could. Banks hated this. Their balance sheets depended on optimistic valuations. Aladdin showed the ugly truth. One government official recalled, "Suddenly we could see which banks were lying about their exposure." The system revealed billions in hidden losses at institutions claiming to be solvent. BlackRock got called in because they weren't part of the problem. Unlike investment banks, they didn't hold these toxic assets. Plus, Aladdin had been stress testing similar securities for years. When the crisis hit, the system was ready. The Fed started sending BlackRock toxic assets daily. Aladdin's team would analyze them overnight and deliver valuations by morning. These reports became critical for bailout decisions. A Treasury staffer described the process. "We'd get these crisp reports at 7 a.m. No fluff, just numbers. Suddenly we had clarity in the chaos." During the darkest days, Aladdin's analyses determined which firms got saved and which got left behind. This raised an uncomfortable question. What does it mean when one private system can decide the fate of banks? The data guided the infamous TARP bailouts, influencing hundreds of billions in government spending. The crisis exposed Aladdin's unique advantage. It didn't take anything at face value. Traditional rating. Agencies had slapped AAA ratings on dodgy securities. Aladdin ignored these labels and ran its own analysis. BlackRock's role surprised everyone. Before 2008, they were just another asset manager. Suddenly, government officials found themselves calling BlackRock more than Wall Street CEOs. One congressional staffer joked, "We should just put Fink on speed dial." The crisis supercharged BlackRock's growth. In 2007, they managed $1.3 trillion. By 2009, that number ballooned to $3 trillion. Much of this came from firms desperate for Aladdin's risk management after getting burned. Aladdin's cool-headed analysis contrasted with Wall Street's panic. While traders screamed and markets swung wildly, the system provided steady, data-driven answers. This calm approach appealed to institutional investors wanting stability. The government work created a snowball effect. After seeing Aladdin in action during the crisis, central banks worldwide wanted the technology. The system went global almost overnight. Here's what most people don't realize about Aladdin's 2008 role. The system didn't predict the crisis, but it was uniquely prepared to handle it. Years of analyzing complex securities meant it already had frameworks for mortgage derivatives. The crisis proved Aladdin could handle real-world stress. Academic models collapse when markets go crazy. Aladdin kept working precisely when everything else failed. This reliability made it indispensable. BlackRock's government work raised eyebrows. Some questioned whether one private firm should have so much influence. Others pointed out that BlackRock now had inside knowledge about every major bank's problems. Post-crisis regulations played right into Aladdin's strengths. New rules required more rigorous risk management, exactly what the system provided. Banks that once resisted now demanded Aladdin to comply. The numbers tell the story. In 2007, about 100 firms used Aladdin. By 2010, that number doubled. Assets under management exploded as institutions sought better risk controls. The crisis also changed how Aladdin worked. The system incorporated hard lessons from the meltdown. Future versions included better liquidity analysis and counterparty risk assessment. BlackRock's growing power concerned some watchdogs. A former SEC official noted, "They essentially became the government's brain during the crisis. Now they're marketing that same brain to everyone else." When historians analyze the 2008 crisis, they focus on banks failing and markets crashing. But the rise of Aladdin might be the most lasting impact. The system that helped clean up the mess went on to dominate finance. Today, Aladdin manages about $21 trillion, more than the GDP of the entire United States. That growth story started in 2008, when everyone realized one uncomfortable truth. Wall Street didn't understand its own risks. Your bank probably uses Aladdin too. Here's something most people don't realize. Your bank probably uses BlackRock's technology every day. JP Morgan, UBS, and other Wall Street giants all license Aladdin despite competing directly with BlackRock. It's like if Coca-Cola sold its secret formula to Pepsi. These firms could build their own systems, but they choose to pay their rival instead. Why would competitors support each other? Think of it like renting someone else's supercomputer for risk management. Building their own would require massive upfront costs and years of development. Banks realize it's smarter to license proven technology than start from scratch. Even BlackRock's toughest rivals admit they can't match the system's capabilities in-house. Here's how it works. A bank like Goldman Sachs pays BlackRock millions annually for Aladdin access. They get sophisticated analytics without development headaches. But there's a catch. Every client that joins makes Aladdin smarter through network effects. More data means better models and more accurate predictions for all users. Over 200 financial institutions now feed information into Aladdin daily: banks, insurers, pension funds, and sovereign wealth funds. The system learns from trades in Tokyo, risk models in London, and investment decisions in New York. This creates a powerful feedback loop where each new client boosts the platform's value. Banks face a simple choice: join the system and benefit from its growing intelligence, or stay outside and fall behind. Most choose to pay up rather than risk being left out. BlackRock anonymizes client data before it enters Aladdin's models, but some banks still worry about information leakage despite these safeguards. The licensing business generates serious money, over $1 billion annually from outside clients. That's pure profit since the system already exists for BlackRock's own use. Competitors essentially fund improvements to software that helps BlackRock outperform them. Here's the paradox. Banks using Aladdin get better risk management tools, but they also make BlackRock stronger. Every improvement they suggest could help BlackRock's traders too. Some firms try to limit what they share, keeping proprietary models for their best strategies. But even partial usage feeds the system's knowledge base. The widespread adoption creates standardization benefits. When everyone uses Aladdin, risk reports look consistent across firms. Pricing models use similar assumptions. Regulators like this setup. It makes oversight easier during crises when everyone works from the same data playbook. Smaller firms face tough choices. Boutique shops can't afford Aladdin's fees, putting them at an information disadvantage. Some try to replicate parts of the system, but lack the scale to compete. This creates a divide between Aladdin haves and have-nots in finance. BlackRock keeps adding features like AI analytics and blockchain integration. Clients get these upgrades automatically, making it harder for competitors to build alternatives. The licensing terms prevent reverse engineering, creating long-term dependency. Once firms build workflows around Aladdin, switching costs become enormous. Some regulators worry about systemic risk if most institutions rely on one system. BlackRock invests heavily in redundancy and cybersecurity to address this. So far, Aladdin has maintained near-perfect uptime despite its massive scale. The client list keeps growing beyond finance. Corporations managing pensions, universities handling endowments, even family offices. Future versions will offer more customizable modules, making Aladdin flexible enough for any institution. This raises an important question. When does a tool become the market itself? Aladdin increasingly defines how institutions analyze risk and value assets. As more players join, the system doesn't just reflect financial reality, it helps create it. BlackRock maintains that Aladdin operates as a neutral platform benefiting all users equally. Skeptics argue the playing field can't be level when one player owns the field. But as long as Aladdin delivers superior analytics, clients will keep paying regardless of competitive implications. BlackRock found the ultimate advantage, getting rivals to fund their competitive edge. While others chase returns, BlackRock earns steady fees from the tools everyone uses to compete. Until someone builds a better system, your bank will keep paying BlackRock for the privilege of using their rival's greatest weapon, the AI that manages your money.